Hello, everyone. Welcome to the webinar. We're going to give everyone a couple more minutes to get on the webinar before we get started. So just sit tight, and then once we're ready, we'll announce it. All right, everyone. Welcome to the webinar. We're going to get started now. So welcome to the When and When Not to Refinance Your Mortgage webinar, and thank you for joining us today. Before we get started, I want to introduce today's presenter, is Jasmine Pena. Jasmine has been a certified HUD housing counselor for the past 12 years and has over 18 years of experience in the housing and mortgage industry. She specializes in first-time loan, LMI, and community development. Jasmine has also assisted with various grants, including the Savings Match Program and the Financial Strategic Planning. Jasmine is passionate about rebuilding the community and social services and received her degree in business administration from Berkeley College. Suffice to say that Jasmine is an expert in what we're talking about here today, so please feel free to ask any questions throughout the entire presentation. I'm not sure if I actually have the things today, but on the right-hand side of your screen, there should be a prompt for questions. Feel free any time during the presentation, ask a question, and at the end of the presentation, we actually have a Q&A section that will go over any questions you have. For today, we're going to be going over what is refinancing, the benefits of refinancing, the costs of refinancing, the bottom line, some last-minute information. We're going to have a Q&A section, like I mentioned, and then the thank you and a survey at the very end. So with that, here's Jasmine to start the presentation.
Hello, everyone. Thank you for joining us today. We're going to be going over a lot of information, and I hope that it's very useful. Please take advantage of the fact that we're all here together today so that you can ask any questions, and I'll be more than happy to answer them for you. So let's just jump right into the definition of what is refinancing, if this is something that you are contemplating. Refinancing is a mortgage, another mortgage. So it's paying off whatever mortgage you have existing and replacing it with a new one. You can actually also refinance a first mortgage and a second mortgage. A second mortgage is considered a home equity line of credit as well. Okay, so you can combine both. Typically, people refinance to combine both mortgages because a home equity line of credit typically has a higher rate. So if you want just one mortgage, you can lump everything into just a refinance, okay? So it's just replacing one mortgage with another one. Okay, so what are the benefits of refinancing? Well, there are many benefits to refinancing. One of them is to be able to obtain a lower interest rates, right? So right now we are in a market where rates are really low. So you're wanting to take a look and see what would be a new mortgage payment depending upon the new interest rate. Some other people, other individuals would like to shorten the term of their mortgage. A term means the length, the time frame that you have with a mortgage. There are 30-year mortgages, there are 20-year mortgages, there's 15-year mortgage. So there are different types of terms of mortgages. So let's say, for instance, you started off with a 30-year mortgage. You've been paying your mortgage for like maybe 6 years, 7 years, and you want to shorten it to a 20-year mortgage. That's definitely an option. Why? Because typically when you obtain a mortgage for 30 years, keep in mind that the first 10 years, you're typically paying off the interest first. The following 10 years, you're paying a little bit more towards the principal of the mortgage. The principal means the amount that is being financed, okay? And the last 10 years of your mortgage, you're really paying off the principal at that point. So typically when you refinance, you really have to know whether or not it's going to work to your best interest. If you are going to re-amortize, right? So that means that you're going to restructure, you're going back to a 30-year mortgage and see whether or not it works to your best interest. Usually when people do that is to lower their mortgage payment in its entirety. Why? Because you're going to stretch the payment out again because you're stretching out the terms of the mortgage. Number three is because you want to convert from an ARM to a fixed rate mortgage or vice versa. So some members go ahead and when they purchase their home, they obtain an adjustable rate mortgage so that their interest rate is lower, right? So let's say for instance, you choose a 5-1 ARM. That means that for the first 5 years, your mortgage payment is fixed because the rate is fixed. But then every year thereafter, your mortgage payment fluctuates because your interest rate fluctuates. And some people just refinance just to have a fixed rate payment and vice versa. Let's say, for instance, you start off with a fixed rate mortgage, but you decide that you're not going to remain in your home for a long period of time. Maybe you're not going to remain in the home in the next 5 years and you just want to reduce the rate so that your mortgage payments can be lowered. So you can also refinance with that objective. Number 4, you can banish a PMI. So a lot of lenders will require you to refinance so that you can eliminate the PMI. PMI is the mortgage insurance, right? So if you have an FHA mortgage and you want to convert into a conventional mortgage so that you can eliminate the mortgage insurance, that's definitely an option because it can save you hundreds of dollars. Other mortgage companies will require you, even if you have a conventional loan, will require you to refinance to eliminate the mortgage insurance. So keep in mind, if you have 22% worth of equity, right? If you have 22% worth of value in the home, that's when you're able to eliminate your mortgage insurance. So the loan to value has to be at 78%. Luckily, with Greater Alliance, if you have a mortgage with us, you don't necessarily have to refinance to be able to eliminate the mortgage insurance, so that'll save you on a lot of closing costs. All you need to do is just go through us and we'll order an appraisal, and if you've made any necessary renovations to the home or any upgrades and you do have that 22% equity, then we'll be glad to eliminate the mortgage insurance. Or if let's say, for instance, you've been paying your mortgage for, let's say, 5 years and you've paid more towards the principal every month, and we see that you have about 22% equity from when you first purchased the home, then we can also review the file and eliminate the mortgage insurance. Other individuals refinance to tap into your home equity. So you finance a large purchase or to consolidate debt. So a lot of people, typically they have a lot of equity in the home, let's say, and they need some money for renovations, then they refinance the mortgage to be able to cash out on the equity so that they can make any necessary repairs or pay for credit cards and student loans and things of that nature. Now, if you're questioning yourself, should I refinance? Is it the right time to refinance? It's a good question to ask yourself, because refinancing can cost between 3 to 6% of a loan's principal, as with an original mortgage. So typically when you refinance, you will have to pay for another appraisal. You'll have to pay for title search. Some banks will charge you application fees. So it's important to determine if whether or not refinancing is a wise financial decision because of all of these closing costs that you will have to pay. And you have to think, okay, if I spend about 3% of the loan amount, if I spend, let's say, for instance, $4, $5, $8,000 to do the refinance, how long would I have to wait before I see the return on my investment, right? So what you will do is I would encourage you to divide the amount that you're going to spend into these savings, and then you'll see how much you'll be, how long you'll have to wait until you see the return on investment. So what I would always recommend is to see if whether or not you'll save maybe 1%. That's the rule of thumb into refinancing. So let's say, for instance, your rate is 5.5%, and if you see that the rate is at 4.5% currently, maybe it is a financial wise decision for you to refinance. Okay. Number two, reducing your rate, your interest rate may not only help you save money, but it also increases the rate at which you're able to build the equity in your home. So you'll be able to have that equity so that eventually if you do decide to refinance the cash out at one point, it's definitely an option. Another great perk to refinance is to reduce your monthly payments, because obviously if you reduce your monthly payments, then you'll have that extra cash on a monthly basis so that you can allocate that to different expenses that you may have at home. So essentially you're going to be saving money each and every month. So as an example, if you have a 30-year fixed mortgage and you're at a 9% interest, just to put it in layman terms, and 9% on a $100,000 home, that's about $804 per month. Versus, let's say, with a 4.5% interest rate, that goes down maybe to $506. So what I would recommend for you to do, just so that you can have a general idea of what your new principal and interest payment would be depending on a quote that you may obtain, is just put on Google mortgage calculator. And on the mortgage calculator, you're going to plug in the principal amount. So if you go to Google, right, go to mortgage calculator, just say that you're going, and then you just scroll a little to like the middle of the page, you're going to see some boxes in there where you can plug in, let's say 100,000 at, let's say 4%, which is where rates are right now. And you're going to put 30 years, right? So you're going to restructure it to a 30-year mortgage. You're going to have an idea of what a principal and interest payment would be. Now, if you shorten the terms of the mortgage, I'd like to share an example with you. So let's just say you have a 30-year mortgage currently. Again, we're putting this in layman terms, not stating that the interest rate right now is at 9%, but let's just say you obtain your mortgage, it was at 9%, and just to show the difference in payment, and let's say you were to refinance into a 15-year term mortgage, same amount principal, and the rate would be 5.5%. So you can basically see right there the difference in payment. Whereas a 30-year fix at a 9% will give you a $817 payment. If you refinance it, shortening up the term to a 15-year mortgage at a 5.5%, you can very well see that your mortgage payment would actually be lower. 804%. Again, you can take a look at your specific case scenario and seeing if whether or not what we call a rate and term would be a wise financial decision. Now, keep in mind, if you refinance to for a rate and term, then your interest rate will be lower than a refinance cash out, okay? Because when you refinance to cash out, the reason why your rate is higher is because you're going to be cashing out some of the equity of the home. So it's we do add basis points. Any mortgage company will add basis points to that. It can be a quarter of a point higher than what you would pay if you would, or maybe an eighth of a point. It really all depends of the basic rate. Okay, so let's say for instance you're wanting to do a rate in term. Let's say your rate would be a 4% versus if you do a refinance to cash out, it can be 4.25%. Now, what can also lower the rate is if you choose a shorter term. So let's say you have currently a 30-year, you want to go to a 20-year, the rate would actually be, let's say, 3.875% just with a rate and term. But if you refinance to cash out, then always keep in mind that your rate would be a little bit higher. Okay, so please keep that into consideration. The example that I'm showing you right now is just showing you a straight rate and term, which means the purpose of the refinance is just to reduce the interest rate and to reduce the term, which is the amount of years that you have to repay the mortgage. Refinancing to convert to an adjustable rate or a fixed rate mortgage. So while ARMs right now are really starting off at lower than fixed rate mortgages, periodic adjustments can result in rate increases that are higher than the rate available through a fixed rate mortgage. So keep in mind, if you refinance right now into an adjustable rate, let's say for instance you choose the 5.530, or let's say 5.130. Let's just keep the same apples to apples. That means that the first 5 years your rate can be, let's say, 3.5%. Keep in mind that once the 5 years is up, then it really all depends on, what's the max or the cap rate. It can be 2%. By the 6th year, your rate can be 5.5%, which would be higher than what rates are nowadays. That maybe rates are maybe at 4.5%. So you have to keep that in mind, that in 6 years the rate might actually be higher than what it is today if you were to refinance into a fixed rate now. Now, when this occurs, converting to a fixed rate mortgage results in a lower rate and eliminates concern over the future interest rate hike. So that means that, let's say if you refinance with a fixed rate mortgage right now, you don't necessarily have to be concerned of where the rates are going to be in 5 years, in 7 years, because you're already locked in to a fixed rate mortgage. So conversely, converting from a fixed rate loan to an ARM can be a sound financial strategy if interest rates are falling. So right now, interest rates are falling, so it may work to your best interest nowadays, okay? Converting to an ARM, which often has a lower monthly payment than a fixed rate mortgage, may be a good idea for homeowners who do not plan to stay in their home for more than a few years. So let's say, for instance, you purchase the home now, but your intentions with the home is to make the necessary repairs. It's a starter home, but you're looking into possibly moving out, selling the home, let's say, for instance, in the near future, maybe 5 years, 6 years. Then at that point, you may consider getting into an adjustable rate, because who cares where the rates are going to be in 5 or 6 years, because you're not going to have that home at that time frame, right? So it really doesn't matter where rates are at that point. So maybe take advantage of the adjustable rate mortgages right now, being that they're really low rates. So why pay more when you can pay less if the ultimate goal is to be able to sell this property in the very near future, right? So an adjustable rate for those types of individuals may be the best product for you at this time. So what are the advantages of refinancing? As I mentioned, banishing the private mortgage insurance. So low or zero down payment options can allow buyers to purchase a home with less than 20% down payment. So unfortunately, they usually require the private mortgage insurance, which is designed to protect lenders from borrowers with a loan default risk. So if you're purchasing a home and you're putting less than 20% down payment, that's when you have to pay the PMI or the mortgage insurance. And that can vary in cost. So that may be $100, it may be $150. The mortgage insurance is typically calculated by 33% of the loan. So what happens is that that can also depend on your credit score. So the lower your credit score, the higher the mortgage insurance as well. So always protect your credit, everyone. Always protect your credit. Try to have the highest credit score because this way the mortgage insurance will be lower and your rate will also be lower. So you can definitely benefit from that. So as the balance of a home decreases and the value of the home itself increases, borrowers may be eligible to cancel the PMI with a mortgage refinance of the loan. So again, a lot of lenders require for you to refinance to eliminate the mortgage insurance, but through Greater Alliance, you don't have to refinance. All you have to do is just pay for the appraisal and we'll be able to eliminate the PMI. Okay, so the lender will decide when the PMI can be removed. Again, you will have to request for that to be removed. A mortgage insurance, keep in mind, it's not something that borrower benefits from, okay? The lender typically benefits from it. So the sooner you can eliminate the mortgage insurance, the better off you're going to be because, again, your mortgage payment will go down because that's eliminated. It can be a savings of $100 or $200 per month. So as I mentioned before, refinancing is also an option so that you can tap into your equity or consolidate debts. People typically refinance to, like I mentioned, remodel the home, remodel the kitchen, add to your home, make necessary updates to the home maintenance, maybe if you want to redo the bathroom. Now, some individuals refinance to cash out and make repairs, let's say to a roof. So I would encourage you that before you even make that decision, possibly speaking to your homeowner's insurance policy would be a good idea, with the understanding that you do risk that the homeowner's insurance may increase a little bit, but definitely speak it over with your homeowner's insurance agent to see whether it's a wise idea to go through your home insurance to pay for your roof, okay? But when it comes to the kitchen or remodeling, that's why people typically refinance as well. I've seen individuals refinance just to take an exotic vacation, although it's not the wisest idea, but it's one of the purposes of the loans. Other individuals take out the cash out to pay for their daughter's or son's education, their college. So that's another reason, or to buy a new car. Again, it's not a wise decision, but again, a lot of people do tap into their equity for, these reasons. So it has to make sense to you. Maybe you want to pay off the vehicle to be able to reduce the monthly expense. Maybe that's a wise idea, but you have to take a look at the pros and the cons. So keep in mind that if you refinance to cash out to pay off a vehicle, that you're going to be paying off the vehicle for the next 30 years. Okay. Now, refinancing to, again, consolidate or to tap into the equity continued. So another justification is that the interest rate is that the interest on mortgage is tax deductible. While these arguments may be true, increasing the number of years that you owe on your mortgage is really a smart financial decision, nor is spending $1 on interest to get a 30-cent tax deduction a wise decision. Okay, so also note that since the Tax Cut and Jobs Act went into effect, the size of the loan on which you can deduct interest has dropped to maybe $750,000 if you bought your house after December 15, 2017. Unfortunately, refinancing does not bring automatic financial prudence. This is a step only if you are convinced you can resist the temptation to spend once the refinancing relieves you off from debt. So, you have to be really careful, and you have to be dedicated that if you're going to refinance to pay off your credit cards, please do not get yourself into debt once again, because you don't want this to be a reoccurring situation. You don't want to continue to pay for your unsecured debts with your secured debt, which is your home, an instrument. This is a mortgage is totally different from a secured debt, because keep in mind, not that I'm encouraging you to not pay your credit cards, but if you do not pay your credit cards, let's say for 3, 4, 5 months, 6 months, sure, it'll take some time to take you into collections, and then wage garnishments can happen, and so on and so forth. But if you do not pay your mortgage for 3 months, that's when initiation to foreclosure begins. And you can place your home at risk of foreclosure if you continue to refinance the cash out to pay for your unsecured debts, increasing your mortgage payments on a monthly basis, and so on and so forth. So you have to be very diligent with your credit cards, that if you're going to refinance the cash out to pay for those, that you don't get yourself into trouble once again. Okay, many homeowners refinance to consolidate their debts at face value, replacing high interest debt with a low interest mortgage, and that may be a good idea for you. Okay, so the cost of refinancing your home. So in general, refinancing includes the following closing costs that are outlined. Typically, you will have to pay an application fee. So a lot of lenders impose this charge to cover the cost of checking a borrower's credit report and the initial cost to process the loan request. You will also have to pay for title insurance and title search. This is mandated by the state, so every lender will charge the same amount for title insurance and title search. So this is issued by the title company, and that insures the policyholder for a specific amount, covering any losses caused by discrepancies found in the property's title. Also, you will have to pay for lender's attorney review fees. So the company or lawyer who conducts the closing will charge the lender for fees incurred, and in turn, the lender will charge those fees to the borrower. So the lender's attorney is the attorney that will review the title work, that will review all of the closing costs, just to make sure that everything is in line, and that the previous loan was paid in full, and all of the liens attached to that loan is paid in full, and everything runs smoothly. You will also have to pay for fees incurred in the loan origination. So a lot of lenders charge an origination fee. Typically, they can charge half of a point or a point for their paperwork, for their work in preparing and evaluating a mortgage loan. Luckily, here at Greater Alliance, we don't have any loan origination fees. We don't charge any processing. We don't have any lock-in rate fees or things of that nature, so our closing costs are very minimal. We will charge you for the title insurance, which is something that everyone charges, and we have to charge you. So everything that's being charged to us, we will have to charge you. And also the lender's attorney, credit report, things of that nature. But we don't have any processing, underwriting, origination, points, any of those fees. So the bottom line, refinancing can be a great financial move if it reduces your mortgage payments, definitely, right? If it shortens the term of your loan and if it helps you build equity more quickly. So you have to think to yourself, is this a smart decision? Will it reduce my mortgage payment? Will it shorten the term of my loan? And will it help me build the equity more quickly? So I always recommend that if you have a mortgage payment that you're paying each and every month and you'd like to build equity, what you can do is a good rule of thumb. If you pay one more extra payment a year, so if your mortgage payment is $1,200 a month, as an example, you pay one more extra payment, or you can do biweekly payments, and you can towards your mortgage. And what you can do is you can shave off maybe 4 years off of the life of the mortgage, and you can build the equity sooner rather than later. Here at Greater Alliance, we don't have any prepayment penalties, so you can actually pay more towards the principal, so that can also help build the equity if you don't necessarily want to refinance. Okay, so that's another strategy you can use to be able to build equity in the home. A lot of people say, you know what, why build the equity? What's so great about building equity? Well, you want to get to a point where if you are, let's say, for instance, wanting a plan for retirement besides a 401k, besides a pension, you don't want to get to a point where you get to that retirement age and you still have to pay for a mortgage. So you want to get to be, financially sound. You want to get to a point where by the time you're retired, you've already finished paying off the mortgage, and all you have to be concerned about is just paying for property taxes and homeowners insurance, and maybe you can live off of the Social Security and your pension or whatever you have planned thus far, besides, not having to pay for rent or just property taxes and homeowners insurance. So that's one of the reasons as to why you want to pay that loan off sooner rather than later. Or you can use that as rental income, right? If you don't have a mortgage by the time you retire and you just have to pay for, let's say, for instance, taxes and homeowners insurance, then you can use whatever is remaining from the rental income and use it to your best interest and your benefit if you move in with family or so on and so forth. So before you refinance, take a careful look at your financial situation and ask yourself, okay, how long do I plan to continue living in the house? How much money will I save by refinancing? So again, the reason why you want to think about how long you want to live in your house is because you want to make that decision. Do I want a fixed rate mortgage, or do I want an adjustable rate mortgage? Okay, and how much money will I save by refinancing? So again, you can use that calculation tool by going to Mortgage Calculator, and you can have a general idea of what your new principal and interest payment will be, and just add in your property taxes. So if your property taxes are, let's say, $9,000 per year, divide that by 12. So you add the principal and interest payment amount plus, let's say, $750, because remember, you've just divided 9,000 into 12, and you also add your homeowner's insurance. So if your homeowner's insurance is $1,000, you add an additional $83 more to that payment, just to give you a general idea of what your principal, interest, taxes, and homeowner's insurance payment will be. That's your pity payment, okay? Keep in mind that refinancing costs may be between 3 to 6% of the loan's principal, and it takes years to recoup that money generated by a lower interest rate or shorter term. So if you're not planning to stay in the home for more than a few years, the cost of refinancing may negate any of the potential savings. It also pays to remember that a savvy homeowner is always looking for ways to reduce debt, build equity, save money, and eliminate their mortgage payment. Okay, taking cash out of your equity when you refinance does not help to achieve any of those goals. So you really have to think about what is the true purpose of the home and what is the true purpose of refinancing. If you ask me my personal opinion, if you're looking to refinancing, I always encourage members to do it. If you have a rate that is higher than 1%, than what we're currently offering right now. It may be a good idea at that point just to reduce the term and maybe reduce the interest. If you're looking to refinance to cash out, really think about the purpose of the refinance. Okay, what's the real reason why you want to cash out? If the purpose is to reduce the overall monthly expense on a monthly basis because you feel that it'll help alleviate your burden, yes, it may be an option, but think also the fact that if you refinance to do that, you're going to be paying off these credit cards for the next 30 years, and you're paying interest for the next 30 years on these credit cards. So it really all depends on what your priority is at that point, okay? Most common types of mortgages, again, a fixed rate mortgage and adjustable rate mortgages. Interest rate for a fixed rate mortgage is constant for the duration of the loan. So you know exactly what you're going to pay each and every month. Not necessarily for the life of the loan, but for the majority part of the loan because, you know, again, taxes may increase or decrease. So that's the only reason as to why that mortgage may necessarily fluctuate, but the principal and interest payment will remain the same. So if interest rates drop, you can always refinance to get a better rate. If interest rates go up, you'll be happy you locked it in at a lower rate. So you don't have that concern of what's going to happen in 5 to 6 years. But with an adjustable rate mortgage, your monthly payments can change over time. Common ARMs have fixed rates for 1, 3, 5, 7, or 10 years. After that, the interest rate will be adjusted annually. So let's just use the example of the 5/5/30 that we have available is the adjustable rate. So typically with the 5/5/30, that means that your interest rate will remain fixed at, let's say, 3% for 5 years. And then after the 5th year, your interest rate will adjust, right? The maximum that it can adjust to is 5%. But then it'll remain fixed for another 5 years, and then it'll adjust, and then fixed for another 5 years. So every 5 years, your payment will adjust. So if you think about it, if you're going to remain in the property for, let's say, another 10 years, maybe the 5/5/30 product will work to your best interest. If you're only going to be there for 5 years, you know, it really all depends how long you want to stay in that home. So we have concluded our webinar, and it's your turn to ask any questions.
All right, so there is a question area on the right side of the screen, like I mentioned before. So now is the perfect time to ask any questions that you may have that you had during the presentation. So we'll give you about 30 seconds to ask any questions. I don't see anything in there now. So we'll give you about 20 seconds, 30 seconds to ask any questions. Otherwise, we'll just move on. So. Okay, it looks like there's no questions asked. We'll just continue to the next slide, which I just want to let you know before we actually conclude that when the presentation actually concludes, you'll actually be prompted a survey. We really appreciate if you took the time to fill that out. One, it helps us make these webinar experiences better for everyone, and we look forward to seeing how we can improve our experience for the next webinar. And you also have a chance to win a $25 gift card, so it's a win-win. So it only takes about like 5 minutes to do. So if you have 5 minutes to spare, we would really appreciate it if you filled out that survey. And the last thing is we really thank you for attending. We hope you got a lot of value out of this information. Please follow us on Facebook, Twitter, YouTube, and Instagram if you have those social media accounts. And just a reminder, after this webinar ends, you'll also receive an email with a copy of the actual webinar. In case you missed anything or you had to get it for any reason, you'll be able to check that out in your email. And we'll also be uploading this to YouTube as well. Below, again, is Jasmine's contact information. Feel free to contact her if you have any other questions that you didn't ask during the presentation, or if you just want more information about mortgage stuff. So, and then there's a link on the bottom below if you want to actually schedule an appointment with one of our mortgage experts. So thanks again for attending the webinar, and we hope you had a lot of value, and we look forward to seeing you at the next presentation that we have.